Hi, I'm Pattu from freefincal. So I've been talking about gilt mutual funds for a while now. So a natural question one can ask is what is the correlation between the equity market and the gilt market, bond market in particular, the gilt market, or how are equity mutual funds and gilt mutual funds correlated? And yeah, more practical, specific question that we can ask is if equity mutual funds are negative, will gilt mutual funds be positive, and vice versa? Of course, as an analyst between asset classes, the correlation will be determined by some kind of a correlation coefficient, R squared, and so on. But that's not an intuitive measure for an investor. For an investor, we have to look at 1 year rolling returns of a gilt index and let's say the Nifty 50. And because the rebalancing frequency is every year, so let's ask, when the Nifty returns are negative, what happens to the gilt return? So what I have done here is, the red line is the Nifty 50 and I have taken 1 year rolling returns. There are something like 4,500 data points or so. Out of that, I have plotted all the instances where the Nifty returns were negative. So the blue dots are negative Nifty returns, 1 year Nifty returns which are negative. So now if you look at the gilt returns during those times, generally speaking, when there is a very large drop in the equity market, when the 1 year return is a very large negative, then the gilt return has been typically positive. So the correlation is reasonable, but it will not happen all the time. Every time it will not happen, but it will happen all the time. The opposite also happens, but it is not frequent. But before I do that, this is from 1999, July 1999. So this bunch means just one time. For an investor, there will be just one instance. So this is 1, 2, 3, 4, 5 instances of large negative returns typically, and corresponding to positive gilt returns. And the opposite, when the positive Nifty returns are positive, not all the time, but sometimes the gilt returns are negative, and the correlation is not as strong. The opposite correlation, when positive Nifty returns and negative gilt returns are shown here. So the point is that this correlation is not perfect. The problem is, our investors want the correlation to be perfect. They will see the equity market dropping for 1 week and they will say, why is the bond market not dropping? Why is the gold market not moving up? Why is the bond market not moving up? Why is the gold market not moving up, and so on? Correlation does not work like that. It will not happen all the time. You can only make some kind of generic remarks. That's all that can be done. So the point I want to make is that gilt mutual funds will be volatile. Last video I had compared equity investing with drinking vodka, and gilt with drinking beer. But the point is that you should have the mentality to look at things at a portfolio level and rebalance systematically. That is, take the profits from gilt and put it into equity, take the profits from equity and put it into gilt, at least partially. With respect to an asset allocation, only then will you be able to exploit this the volatility of both equity and gilt. So there are other questions also I have answered here. That's the second part of the gilt FAQ. So please do check them out as well. Bye bye.